right? So we have 3 plans, right? Whole life, term life, index universal life. Okay. There's actually a VUL out there. We don't sell it. We don't have a license for it. So we're going to strictly focus on index universal life. Okay. So what is it? It's a permanent plan. It's like a whole life, but the difference between a whole life and an IUL, the IUL allows the cash value to be placed in the market, S&P 500. So it can go up, it can go down. Okay, but there are floors with it. Okay, compared to a whole life, the interest rate is fixed. Okay, typically back in our old company, it was 4.5, 5%. That's it. No matter how the market goes up or goes down, it's fixed. It's locked in. Okay, so there's going to be 3 things with an IUL. Let's say we use a policy for $100. Okay, you got the face amount, you got the premium. The premium is actually split up in 3 spots. Okay. These 2 are your cost of insurance. Okay, so call it the upkeep, the maintenance fee, the administrative fees. So that's the fees. I call it janitorial fees. Okay, and then the second one is your risk. Okay, this is your age, your health, your risk, your profile, how healthy you are. On other IULs, there's 3 ratings if you do a fully underwritten IULs, meaning your standard, preferred, premier, or you can go below that in certain carriers. So that's your risk cost. So these are the 2 costs, and then the remainder will go to cash value. Okay, so that's how your $100 gets split up. Okay, so what's the benefit of an IUL? Well, the cash value can be placed into a market, certain markets, certain S&P products, certain IUL products. This is where they compete on. Okay, they're going to compete on, we have a floor, so this goes into the market. Okay, certain products, they have a floor of 0. So even if the market tanks, it's a 0. Certain products, they have 2%, and then they can promise between 12 up to 15%. Okay, so the stronger the carrier, the more products they offer, the more clientele, the more solvent the company is. This is where they're really competitive with. Yeah.
So with the experience that you have with our company and what we've been writing, which are the carriers that you prefer to use that would have the 2%?
Yeah, so I'm going to go on to that. So
can you repeat her question just for audio's sake?
Okay.
Just like someone else.
Yeah. So her question is, so from the products and the knowledge and all the things that we know, what would be the preferred carrier? Okay. So I'm going to answer that in a little bit. I'm going to answer it shortly now. So we have 2 types of IULs we want to use for our clients. Okay. To answer that question, that answers a question for a cash accumulation product. Okay. When we sell IULs, we're either selling it to a death benefit, which is cheaper than a whole life, or we're selling it as a cash accumulation benefit. So I'm going to just keep it at that, because what I'm going to go through is I'm going to go through the definition of the IUL, the carriers that we use, and then our clientele, our target market. Okay, so that kind of comes into that, right? So, but so far so good, right? So if it's $100, here's what happens. The IUL and the risk, this changes. Compared to a whole life, which is fixed, this goes up incrementally, year by year. Okay, so this is where you can also see some IULs go upside down on you if they're underfunded. Okay, so for example, if we have a 30-year-old, okay, this 30-year-old pays $100 for a face amount. Let's say it's $200,000. Doable, right? Okay. The IUL definition, sometimes you won't see this in policies when you look at it. You won't see the IUL. You will see flexible premium adjustable life. Okay, you can flex your premium or you can adjust the life. So how the $100 will be broken down, you got your janitor fees, your administrative fees, that's fixed. That's usually like $5 to $10. Okay, your risk then would be your cost of your insurance at a 30-year-old for the $200,000 at that risk at that time. So let's say that risk, it's like a 1-year term in a sense on the price, it's $50. What do you have left? 50, 55? You got $45 left. So the remaining money goes into the cash value. So not the whole $100 gets invested into the market and played in the market. The remaining cash value goes to the market. What happens next, though, is that every year, as your risk increases, fee stays the same. But if this becomes 55, guess what? Now how much left do you have being funded to? Now you're at 40, okay? So this is very important when you illustrate, because you guys as the agent, you can choose how to illustrate your IUL. You can choose how much the client can pay or the client can tell you, and you can choose how big the face amount would be. If we had a face amount of 100,000, how much would the risk be? Would it be higher or lower?
Higher. It's lower.
It's lower, right? Lower because the cost of insurance for a 30-year-old for a 200,000 will be less compared to 100,000. If this was lower, guess how much more cash value comes in? Goes higher. More cash value goes, because if this is lower, the cost of insurance is lower. Let's say the cost of insurance is only 30 because it's only 100,000 instead of 200,000. Now we got, what's that, 35 instead. So we got $65 goes into the cash value. Does that make sense?
Yes.
So this is what you're playing with. This is what it means by overfunding or underfunding an IUL. Okay? So if you got a client that want to tell you, I want to get a $500,000 insurance policy, but I only want to pay $100 a month, that's when you know you can make it happen if you tabulate it correctly, but there's going to be little cash value that builds up. So it doesn't matter if you have a 2% or a 15% interest rate, you're not funding the policy.
They would have to get at least 300 to go.
You'd have to fund it, or you will see it when you start illustrating, and we'll show that on 201, where it'll tell you, based on the rates, man, you got a 9-year policy, 7-year policy. Yeah. So in certain companies, if they don't explain this correctly, they're just pushing the IUL, all the benefits and all the bells and whistle, but they don't properly fund it. Client comes back 15 years later, they thought they're gonna have the magical numbers that was shown in the illustration, and they're upside down. They're out of a policy. Because as you get older, let's say this guy is 40, the cost of insurance now becomes 95, $5 here, we're at 0, right? They turn 41, this becomes 100, this still is 5, but they're only paying 100, they're negative 5, so what happens now?
Zero goes on negative.
No, negative 5 comes out of the cash value.
So it eats it up.
Correct. So what's going to happen with the cash value in the IUL? It's automatically creating a loan to fund the policy because you're short on it. So when you become short, policy starts depleting. So it's very important when you sell IULs or you see a client and you review a policy with an IUL, you look at their annual statements, okay? You guys notice the HMS CBO product, if you guys have been here for a year, when you sell one, the clients actually get an annual statement. Okay, because did you guys know the HMS CBO is actually an IUL? So it's set up, it's sold as a term with a return to premium, known as CBO, but term policies don't build cash value, so how do they return the premium? It's actually a universal life, tabulated correctly, not to create enough cash value, but tabulated correctly to where in 30 years, 25 or 10 or 15, whatever the policy you sold, by the end of that year, that amount of funding of the premium is equivalent to the total premiums they paid into the policy. So if I have it, which I do, I have a 30-year term policy or term with the return of premium CBO with Americo. It's specifically tabulated by 30 years that I paid into policy, I will get the exact premium I put in. So that's why they call it a term with an ROP. But in technicality, it's an IUL. So that's why you get an annual statement. Okay, so you will see that. On annual statements, it'll say, based on the premiums you paid into this, based on how long you're gonna have this is how long this policy will still stay in place.
Another question, I'm wondering for a policy like that, if I see that my members in the cash accumulation part is down, can I then come back in with $800 and fund it that way? Or
Right.
is there a ceiling for that?
Yeah, so that's called a MEC, but yeah, so remember how I mentioned what an IUL's real definition is? Sorry. So the question is, if I see a client and I see a policy that's underfunded, can I go and pay additional premiums to that? Yes. Okay, but there is a limit to how much you can overfund it. It's called the modified endowment contract. It's a MEC to make sure it's not an investment. But yes. So let's say you see a client, they're 10 years into the policy and they're missing some premiums or they're short on premiums, it's gonna lapse. The company will send them a letter saying, hey, you should overpay this. You could pay more to keep this going. you can overfund it. And that comes back into the original definition of the IUL. It's flexible premium, adjustable life. So you can actually flex your premium, pay more, pay less, or adjust the life to make it.
So the number at any given moment can be as high as catching up would
Correct.
allow it,
The number can be any given moment to catch up, or you can actually go down, lower it.
as long as it's staying at the MEC where it doesn't over.
Yeah, correct. As long as it's not above the modified endowment contract, you can fund it as much or as little as you want.
Cool.
Yeah. So going back to this, remember how we talked about the risk, right? So I have a $200,000 policy for $100 a month. If my minimum, so there's this thing called the minimum premium needed, okay, which is the risk. So this would be it. If the minimum is 55 and 5, I can pay at minimum $60 to keep this policy going, but it doesn't build cash value. But you set it up to pay 100, so it builds a little bit, right? So anything higher than 100, you can call the company and say, I want to pay more, I can pay more. You can tell the company, I'm having a hard issue with my money, I want to pay a little bit less, you can.
Is that something that we can periodically, like say for instance, 3 months into the policy, go back to our client and say, hey, now it's time to overfund? Or if you have the ability to, when I showed you the illustration, it's based on this, we see that you're not doing it. And so as your agent, I would advise you that this would be a good time to pay a little bit more on your premium. Can we do that as agents?
Yeah, as the question was, can we review a policy 3 months in, tell them to fund it, overfund it, underfund it? Yes. But what you want to do is whenever you show an illustration, this is an illustration assuming that they're going to pay this policy for that certain period of year, for that certain period of time. Anytime you do so, it changes the illustration. So it's good to call the carrier to ask for a new illustration on that. But also as the agent, for time's sake, you don't want to have to keep revisiting a client because what you're going to get paid on commission-wise, you get paid commission on this target premium. So revisiting the client won't exactly do much. Also, commission-wise, anything that the client overpays, you're not getting commission on that. Your commission is the target premium of the cost of the insurance. So this part, anything over, you don't get paid on. So you can tell the client, hey, yeah, pay $300 more. Nothing happens to your pocket. It builds their policy better, though.
Yeah, I mean, you want to have repeat business and you want to come back and grab their children. And
Right. So just as a quick definition of what's happening in the IUL, any specific questions? So there's three, I just want to get over the three main things, that there's the fees, the risk, total combining it, the cost of the insurance, and then anything over or under will be the cash value. So you will see some underfunded policies. If this goes higher than that, if this becomes negative, it drains the cash value. Okay, it can be a point where, let's say this is now $200, this is still $5, the cash value is $200, they're short $5. When that's happening, clients will get a letter saying, based on the next 3 months, the next 6 months, your policy is not looking too good. And the clients come back at you and saying, what do you mean? I paid 15 years into this policy, I have nothing left and I got to start over? Yeah, you didn't know? And so we come in, it's like, sir, miss, you're 70 now. We don't have a lot of options. We can sell you a whole life. Now you're unhealthy, all that stuff. So it gets tricky. So when we're selling this, some plans, the type of plans that we have, we can set it up, or they can set it up where it's more of a death benefit. Death benefit means it's going to last forever, so this won't have an issue. Or we can set it for a cash accumulation, which you're going to use the cash value is more of an investment type. Okay, so I'll show you both. Okay, so questions on just the specific basics of the IUL. Good?
How much more would the client be able to fund the policy?
Okay, so that's what the MEC is. So how much more can a client overfund this policy? So when you tabulate it, there's this thing called a modified endowment contract. Back in the days, you could buy a $100 a month policy and then put $1,000 a month into it. And then when you're doing that, it's like, dude, it doesn't matter if you have a $100,000 policy, you can overfund it. Now you're super overfunding it. Well, IRS got involved and said, hey, you're overusing the taxable benefits of a life insurance. This is an investment. No, we got to set these limits. So there's a limit called a MEC. So for example, you can't go 7 to 10 times too much into the policy. 2 overfund that, what you have to end up doing is you have to increase the cost of the insurance. You have to increase the death benefit. So in reality, you can fund it as much as you want. We just have to arrange this higher to meet those levels. Right. So, and then that matters based on their age, matters based on their health, and the amount of life insurance. So that usually happens. You can actually tabulate it and create an illustration where you can create the most minimum minimum coverage amount with the max funded premium. So you can put it in the illustration that says, I want to pay $300 a month. I don't care about the death benefit. Okay, well, great. So we'll start with 100 or 200. We'll keep this at the very minimum level to max fund this. And the illustration can create that.
And you have to do that in the beginning when you write the policy, right?
Right. So when you're doing a policy, so her question is you have to do that at the beginning of the policy. There's actually two things when you're doing a policy. When you're creating a policy for accumulation method, when you submit an app, you have to get the client underwritten, get them approved based on their age, their health, and also, remember I was mentioning, if it's a accumulation policy, there's standard, preferred, or premier type rating, which lowers their cost of insurance. So there's that part. And then once you submit that, you also submit an illustration with it on how you want those premiums created. So it's not as simple as a term policy or a whole life policy where you just apply, get it approved, wham, bam, thank you, ma'am. There is. We have one with Mutual of Omaha, Indexed Universal Life. Yeah. So basics of IUL, we went through this. So now the types, right? So two types. Okay, so we have a cash accumulation type or death benefit type. Okay, so we have a couple of products and carriers to this. Let me ask you this. If we have a 60-year-old, how many years can they accumulate a policy?
So they're 85.
Okay, how much is their cost of insurance if we do an IUL for them? So would you rather sell a 60-year-old if they're healthy, a death type benefit or a cash accumulation benefit? Death benefit. So I would say 50 plus age group, we're selling the death benefit on this. Okay.
Unless they have heavy liquidity.
Unless they're funding it, then maybe annuity will come in, right? Because really, in reality, you're not going to be able to create enough compounding interest at that age. You can, but you have to really fund it like $2,000, $3,000. You got to put mortgage payment premium prices on it, right? Okay. So you can. Sean Ruggiero, if you guys follow FFL AMS, he had a little box. Like if you're in your 30s, to have a good IUL as a tax-free retirement, you should be putting $1,000 into it a month. If you're in your 40s, like $2,000. In your 50s, like $3,000, $5,000. Yeah, just like a rough average to make enough of a cash value where it's nominal. Because if not, you're better off as a death benefit. Okay, so if we're doing a death benefit, we have a great product out there. So product-wise, we have Mutual of Omaha, IUL E. Okay.
I have a question. So
Sure.
in that case, like you have a 50-year-old
Okay.
person, would you recommend an IUL or would you like recommend just like a regular whole life policy?
So her question is, if we have a 50-year-old person, we're sitting with them, would I recommend an IUL or we recommend a final expense policy? Okay, so it comes back to the client, right? It comes back on what their needs are when it comes down to life insurance. What is the client wanting to do? Do they want to provide a big death benefit for the family? They want something that accumulates as a retirement plan, or they want to just take care of the mortgage, right? So if you're telling me you want to take care of the mortgage, what do I say? Get a term. What do you need the cash value for? You're just covering your small liability. If they tell me I just want to be cremated, doesn't matter if you're 50 or 40, okay, let's get you a $5,000, $10,000 funeral plan, right? Now, if you're talking to a 50-year-old that's a business owner with no benefits, no retirement plan, it's something different, right? So they have big assets, big premium they can pay. They got no backup plan. We can talk about IUL to them. So that's the conversation. You want to see what their income budget is. Yeah. So then if they're willing to fork out $1,000, $2,000, I can kind of set up a big death benefit plus a little bit of accumulation. But I would really go, if they want something accumulation side, this is, I would say, between the 20s to 40s, right? I would ask the 50-year-old, you got a young wife? You got a daughter? We can set up an accumulation IUL that's going to cost less and build up more and have a bigger cash value accumulation, right? Do you have a child? Do you have a 4-year-old, a 3-year-old? We can set up an IUL where they can be set up for life if you start it now, and it'll cost less than what it'll cost you, right? So that's when you would sell the IULs. So that benefit-wise, let's go back to this with the products. We have a couple. So Mutual of Omaha. Anyone here that gets contracted automatically gets a Mutual of Omaha. For anyone 50 and under, you can actually go 18 to 50. Mutual of Omaha has up to 300,000 that you could do no physical exam. Okay, 50 to 60, they can get 250. And this is the best for clients that are really healthy. 60 to 70, they can get up to 150, no physical exam. So when you see a client, they're in their 60, 65, 70, they're completely healthy, no medication. They laugh at you and look at you on a $30,000 whole life. You can sell them 100,000, 150,000, and they're willing to go for it. You can save them some money. It's only 10% off your comp, but it's more set up as a death benefit. Okay. So this is Mutual of Omaha's Easy Solve. Okay, the Easy Solve is what you can quote on off of your application quoter. If you want to do a non-Easy Solve, you have to go through what's called WinFlex Web. Okay, winflexweb.com. You can create your illustrations for almost all IULs available, or you can go to each individual carrier, run their illustration app. Okay, so now. What's more important is the cash accumulation. If you want to do a cash accumulation, we have a lot of companies and carriers in this. This is where it gets a little bit tricky though, because you normally would have to get contracted first to get the app. And then we have a lot of great products, but then FFL AMS wants you to have a client to sell first before you get contracted. So first things first, you want to get an FFL AMS account, get your Athene, be able to have access to them. And then they have to ask a specialist. They have a PDF file, or you can do it off your ILC, ask a specialist off your gateway. The IO will have a couple of questions for them. What's the client's age, their health, what are they looking for, what do they want to protect, how much is their target premium, all these things. The FFL AMS can take that information, canvas all the products and carriers that we have, spit you maybe 1 or 2 illustrations that you want to request, and then they'll also send you contracting information for it. Okay, so we got to get those things out the way. A lot of things back in the days, as FFL grows, we have 15,000 plus agents. They got bombarded with too many carrier contracts for too many agents that don't even write. And so it was costing too much money, costing too much paperwork, administrative. So now they took a step back to say, okay, let's get you contracted when you're ready to write. So it's a little filter, okay? So good companies to use, okay? So FNG, okay? Global Atlantic, NLG, and then also
Are those companies listed in order? Like from best to least? No.
oh no, I was just naming them off. Yeah, so FNG, Fidelity and Guarantee. Yeah. Clifton was asking, are they in order? No, these are just what I'm listing off the top of my head. There's others. There's North American. It's a bunch, man. They're good. They're all good, but they're all the same. So what happens, going back into this, when we're doing these applications, so there's 2 types of products, and there's 2 types of underwriting. Okay, so as you guys know, there's simplified issue, there's fully underwritten. Okay, so mainly these type of policies in here, they're fully underwritten. Okay, now NLG is up there. Are they the most competitive? I think FNG's higher accumulation. Okay, but it doesn't matter if you can't get the client approved, right? So NLG might be lenient. NLG has up to a $2 million policy. They have a peak life, flex life. If they're under 50, you can do up to $2 million, no physical exam. You can get that submitted, illustration, boom, they'll take care of everything. And they're one of the few companies in California that has living benefits. So now you sell the IUL, you sell the cash accumulation, you tell them they have chronic illness, terminal illness, critical illness benefit, takes care of everything. Okay, so if you guys were there last time, we had Martin? Shoot. Our NLG representative. Son Martin. Drew? Drew? Shoot. No, so we have an NLG. We had a training. It was just the basics of NLG. Devin Martin. So we had him. He was training about it. It's really good. Okay, so a lot of good things with NLG. Little drawback, it's like 30 to 40% off your comp. You sell FNG, they're as lenient as NLG, but they're fully underwritten, but they're paying you like Mutual of Omaha's IULE. They're only 10% off your comp. So what do you choose, right? Good accumulation, decent, okay underwriting, pays me more, right? Global Atlantic, I like using them. They have 2 products. Okay, they actually have an accumulation product and they have a death benefit product. Okay, so with Global Atlantic, they have what's called accumulation, foundation elite, and foundation elite is really good, like a death benefit. You can have it to where it's set up for a client. They apply. Anyone between 50 to 70 is really good for it. If they're healthy, they can get standard, preferred, premier. I wrote up a 72-year-old in May, got a premier rate, got $100,000, and the standard was $400, but the premier rate was only like 300 something. I got a 73-year-old getting $100,000 for $300. You do a final expense on that for $30,000-$40,000, that's $300, right? Yeah. So they have a really good death benefit. The issue with them, their underwriting takes a while. I sold it in May, I issued in August. Sold it in May, issued in August, no lie. It's decent because it was like a, what, $300 a month policy.
$300.
Yeah. But see, the thing is, so it's like, at that time, you know, what are you doing for? Are you doing it for the client? Or are we looking for a better rate for them? Are they healthy enough to qualify for this? You got to know, right? Because here's the issue. When you do a fully underwritten policy, you think it's nice and dandy. You get them approved, but they get declined. If they got declined, then there's an MIB. Now you can't even fall back to a final expense.
You dent the record.
Right, you dent the record. But luckily, you know, we have other companies now. We have AIG that doesn't, SIWL that doesn't check MIB. So it gets complicated within on what to use, what not to use. So at that point, what's great for us, use FFL AMS. Okay, here's the situation, here's what the client, if they're fine and healthy, FNG or NLG would be the best way to go. Okay.
I think you guys would be able to do like a illustration class on how to actually do the contract so that we understand.
Contracting? So you want to do a class for contracting or creating? Oh yeah, I'm glad you said that. So now we just went through the definition of an IUL, the clientele, and the type of policies. Okay, so now let's get into creating an illustration. So as I mentioned, we need to do what's called WinFlex Web.
Yeah, that I've never.
Where? How do I use this? Wait. There we go. Oh, oops. Okay, so let's go and review what WinFlex Web looks like. Okay, so first off, winflexweb.com, you need to create the account. Okay, you don't want to do it right when you're with the client. You got to create the account and then you add the carriers. Okay, so it takes about a day because once you have your account, then you add your carriers, then you can get access to each carrier. Some carriers, they require your agent numbers to be able to access their information. Okay, some don't need it, and so you'll be good. All right. Log me out. Okay. So you create an illustration. Okay. Once you create an illustration, it'll tell you start a new case. And then you can see what carriers you have access. Okay. So Accordius, Global Atlantic. I'm going to just blow this up. There's American National, FNG, Mutual of Omaha, National Life Group, North American. I didn't mention North American. It was actually one of the good high interest rate companies, cash value accumulation companies that we have. But the underwriting was not so good. Okay, so we do our underwriting. We follow up with our cases, right? The way they had it, if you called home office, North American, they don't talk to you. They say, hey, talk to your manager in charge of your IMO. Talk to your IMO. So I had to go call FFLAMS to tell me and talk to them as the mediator to talk to them. Wow. I tried to get a policy on my child. I'm the owner, I'm the policyholder, I'm the payer, and I'm the agent. They didn't want to talk to me. I'm like, you guys must not want business. Okay, bye. I canceled it. Yeah, they were saying I had to go talk to my manager, the IMO marketer, to talk about my business. How can FFLAMS take care of all of that for 15,000 agents? So we came out with great products, but yeah, back office, confusion. You'll never get a policy issued that way. So that's been an issue. So I actually created one for FNG already, but I guess I got locked out and it deleted it.
Do you have Athene in there or?
This is Athene is the annuity. Yeah, right. So I'm just gonna, that's how you would get in. Aside from that, I'm gonna show you what the illustration looks like already. That's gonna be okay? But basically with the WinFlex Web, all you do is you put in the client's age, health, you put in the premiums they're willing to pay. You want to do target premium or you want to do specified cash value accumulation. It's very to the point. The only confusion that you can have is you can say, I want to pay to this age. I want to start taking money out to this age. Okay, so it's very simple. But why we don't need to do that is that if you use FFLAMS, you can tell them what you want from the client. They'll give you this. And they'll do it right. So you tell the client, so here's this example. I mentioned that I want a 21-year-old who has a decent income, okay? So this is an FNG, life insurance. It's called Path Setter, okay? So, let me go back. So, as I mentioned, with the Universal Life IUL, it's a flexible premium adjustable life or adjustable death benefit, okay? So each one will have their own specific cool looking illustration. So it's good for wealth transfer, cash value accumulation, living benefits, supplementary riders, okay? But Mary Jane, I told the illustrator that the client's willing to pay $250 a month. I wanted to do max funded, lowest coverage amount available. But remember, I was saying if they're young, their cost of insurance is low, we can't hit over the MEC. Okay, it was hitting the MEC that the minimum face amount had to be $323,000. At a 21-year-old rate, their minimum needed to be $323,000 to max fund $250, which is not bad, right? That's good. Okay. Now, at 21, would you say she would have no health conditions? So I put her as a preferred. Remember, there's standard, preferred, premier. Each company will have their name for the highest rating. This is the highest rating, preferred. Okay. So on the illustration, it'll be a big contract, how much it is, the whole glossary of all these things. What's important to go over are the guarantees, middle percentages, and current. Okay, so there's always going to be 3. Okay, so $250 a month multiplied by a year, that's $3,000 a year. That's what this left side is. Her age, the year she's paying into it, if she's borrowing any money, and what accumulation numbers would be if it's the guarantees, middle non-guarantees, and the current non-guarantees. So far, so good? Yeah. Okay, so what's saying here on the guaranteed is that no matter what the index is associated with, they're promising a 0.25%. If the market tanks 0, no gains year per year, it's 0.25. Okay.
Better,
It's still better than the bank. Now, will the 3,000 be the one building all the cash value? Remember, there's a risk to it, right? So the risk is the 21-year-old for the 323,000, but the remaining premium out of that 250 is going to go to the cash value. Even on the first year, they have accumulation 1842. So if you look at it, 3,000 out of 1842 is like 1,200. Is the cost of the insurance. Okay, and then it keeps going up. Another 1,800, 3,600. So that's when you know it's around the risk is 1,200 a year. Okay, so I had it as a death benefit level. Okay, so the cash value is completely growing and growing with it. Even if the market tanks year per year, the guarantees are there. Okay, so now it's just age 80. And it will last their age 84. Okay? So if there was no market gain from 21 to 63, she will still have a $323,000 policy. But do you guys notice why the cash value kept going down? Oh, too many fingers. You see how this was going down, this was going down, this was going down? Yeah. What was happening in the cash value?
It's depleting.
Why is it depleting? Her cost of insurance. She was getting older. Her cost of insurance at 63 to cover the 323, it's looking like 10,000 plus. Okay, which is $1,000 a month, which is probably right for a $323,000 policy at age 63. So the idea is, if you were building this cash value and you're overfunding it, that's going to be nominal compared to the numbers you have, and it will be because you'll see these numbers here. So now let's go into the non-guaranteeds and guaranteeds. If this client continued to pay the premium and the interest rate is only 4.75, the compounding interest from age 21 to 65, how many years is that? 44 years with enough cash value? Her cash value will be 1.715. Now, because her death benefit is increasing with it, now because it's pushing it with the cash value, her death benefit, if she never taps it into it, it's about 1,800. See that? Mm-hmm. I mean, 1.8 mil, not 1,800. Right? So what I did, though, is I told the company, the illustration, to get a max funded amount. I want her to stop making payments at the age of 65. So she pays it from $250 a month, from 21 to 65, and at 65, she's done making payments. Mm-hmm. She's going to start periodically taking money out.
the withdrawal, the 589.
Right, you see that? Mm-hmm. This is what's called a tax-free retirement. If you get a 21-year-old willing to pay into this with an F&G account, planned premium of $3,000 AP, she can take out $500,000 year per year per year per year per year.
No
Until
job will ever give you that.
And I had her set up all the way till age 86 to see how much she can get out of it. I'd only illustrated till age 80. I'm sorry.
Actually, that was.
I actually did it till age 80 for her. Until age 100, basically. You're 80 into it. Mm-hmm. Okay. So she can take all that out, or she can leave it the way it is. Okay. You can choose to do it on a year to year, leave it, let it grow. It accumulates even more. Can she do it later? Can she do it at a younger age? Yeah. Actually, it didn't load the original one. I had it changed to where she starts at 65. I don't know what happened. It didn't save the other one.
So 65.
Yeah, at 65, she'd have like 888,000.
And a death benefit of $1 million.
Yeah. The longer she keeps it, the more it's a wealth transfer, tax-free accumulation. So this is where you can tell clients, like, you can have a six-figure paycheck year per year. And the benefit of an IUL, it's a loan out of your life insurance, so it's not taxable. So you can collect Social Security. You can be on disability and collect this, and they're not going to take it away. They're not going to take Social Security away. You don't got to pay taxes on this.
How would this compare to like a, what do you call it, like a Roth IRA or like one of those work ones that they have?
Mm-hmm. So how would this compare to your pension, your 401k, your Roth IRA, your individual retirement account? So it's similar to that. Okay, so the difference between that is you paid qualified money into it. It came out of your paychecks before. So it was tax deferred. This one is tax free. So the difference is tax deferred means you didn't have to pay taxes until you started taking it out. Once you start taking it out, it counts towards your income footprint. Then whatever you receive for Social Security plus that pension, let's say you're making six figure, well, now that's your tax bracket you have to pay for, whatever you're receiving with it. And this is tax free. So whatever you're receiving, let's say you're only taking $36,000 into your Social Security, what you take out of this doesn't add to that. Your tax footprint is $36,000. Right? So, and sometimes if you're on Social Security, you don't have to pay taxes for it. You're golden. Right? So that's the biggest difference is the taxation. Yeah. So what can you do with this? There's a lot of confusion for parents. Sometimes agents say it like, you can start it on your kids. They can use it as a college education. We don't recommend that. It's not enough. There's not enough years to accumulate cash value. But they can use it as a down payment on a house, or they can use it as a retirement income. Because now you started a plan at the age of 10, and they're set until they're 60, 65. All you have to do is let them accumulate and let them take over it.
I find this is good to present as a mortgage protection because of how the market is changing with properties. You really can't afford to get a mortgage protection. I mean, like you said, with certain policies, the amount is only $350,000, where the average house is 600 something. Not even the average. The average house is almost $1 million.
So in California, her situation is this might be a better solution for a mortgage protection in California because we don't have $450,000 homes. Correct. A term would also be good. A level term would be good because it'll just be strictly for the mortgage. But if they have disposable income, they want a tax-free retirement, yes, it can help out. But remember, the cost and the risk would be higher if they're in their 40s, 50s. But if you got a brand new homeowner in their 20s with a good job, yeah. This is actually great for teachers too. So NLG has a great target for teachers, teacher funds, because as you know, with your pensions with the teachers, it's based on the 2% rule of your years plus the amount of service plus your age, multiplied by your salary at 2%. They typically get about 70 to 80% of their take-home pay. So there's a missing gap. Okay, there's a gap from Social Security. There's a gap of that. This can alleviate that gap. Yeah. So it's similar to a 403B option or a IUL for that client.
I like it.
Right? Yeah, this wasn't illustrated correctly. Let's create one since it's set it at year 65 instead of age 65. Okay, so we have time? We're good?
Yeah.
Okay, so this is FNG. Pass setter. Okay. Start a new case. It's going to load.
What would you like to do?
Would you like a male or a female? Now, age cost, females are less, male costs more. What do you guys want to see? Male?
Yeah, let's do that now.
Male? Okay, what year do you guys want? What birthday?
91.
91? So 1/1/91. Let's just do 10 then. 90/91. Okay, so they will be 31. Is that good?
Yeah.
Okay, so class, with FNG, non-smoker is the standard, preferred is the middle, preferred non-smoker. So they only have preferred non-smoker is the highest, okay? We're gonna put California. Okay, so that's the first part. Okay, your table rating, your coverage. Now the next part is the solve for, okay? So you can either do a no solve, you can do a premium solve, meaning find out how much it costs, or a face solve, okay? Face solve's the easier one, because we don't care about the face amount. We want to tell them how much we were willing to pay. So we could put minimum non-MEC. So it doesn't hit that MEC, the modified endowment contract. So it's not an investment account. So that's how we click on that. Now premium amount, you guys tell me. So you come back to the client, okay? 31-year-old, how much are you willing to pay for your IUL? Okay, what's a comfortable premium? Annually, monthly?
170.
170?
Now let's do like 350.
350? Okay, let's go big. Let's go big. 350, bigger numbers.
500.
500? $500. This auction's good. Okay, so
He's
I
getting
was trying to go
paid.
easy.
500, which is good in their 30s. 500 is a good, because so this is where you can push in as a sales individual, right? So as a sales agent, you tell them, look, are you looking to do this as an investment or like a pretend fake investment? Like, what are you investing with $200, $300? You tell them, get out of here, man. I only deal with affluent clients. You're not affluent. You're poor. You're a poor client. Okay, so next, index crediting options. So it shows you the interest rates, the current and whatnot. It's set on Barclays Trailblazer. Leave it the way it is. Okay, the illustration rate on this is 6.91. There's a higher one at 7.19, which is the S&P 500 point to point, 100%. Leave it the way it is. Unless you know how to do these index strategies, you're fine with where it's at.
Question. Is it, with F&G, is there a specific reason why it's on Barclays and it's not split 50-50 with S&P point to point?
Is there a specific reason? No, they probably have like a great relationship with that specific index over the other. Nah, you can choose though. So it's who they have a relationship with, and you can be the agent and do it. You can do 50-50 if you wish.
Okay.
Leave it the way it is.
1% bonus though, and the other one doesn't.
Right. See, with 1% bonus. This one has 100%. This one has 140. But all in all, these are just the illustrations, and there's caps. Okay. So in here, here's the difference. Why is set on default? The maximum illustrated is 6.91, which is the current. What about the cap? There's no cap on this one. This one is 12.5 cap. All right, so now we're gonna go into disbursements. This is a common used to get the money. I had an error on this, that's why it didn't show right. So we're gonna do loan. Disbursement amount, we're gonna solve. Okay. And we're gonna create my issue that I had on that is I put year instead of the age. Okay, so we're gonna disburse from 32 to 65. We're gonna put none because we don't want to take anything right now, right? Okay. And then from 65, let's say to age 86. Or 66 to age 86, we're going to do the solve. We're going to do the max. And after 87, we're going to put none. Okay? Let me go back real quick for the solve for. The premium amount, you can also choose the calendar and when and how long you want to pay it for. Do we want to pay it forever? Or we want to go and pay it till 65, right? So we're going to pay $500 a month from 31 to 65. And then from 65 and on, we're going to up it to 10,000 now. We're just going to put a 0. We're going to keep funding this. We're going to win the lotto. So we're good? All right, so we're paying from 31 to 65, and then we want to disperse from 66 to 86, okay, for the next 20 years. Policy options. You have an option here for premium mode for annual or monthly. So make sure you put monthly. Annually, if you paid an IUL annually, it builds cash value faster because the company received the money faster versus monthly. Okay, so it makes a difference on the illustration. You have an option for level or increasing. Let me explain that. Level means the face amount stays. Increasing costs and increases the cost of insurance because it increases on top of the cash value and the death benefit. We had the notion that it's always better for increasing, but Devin was saying it's better for a level. They gain more cash value. So I'll take his word for it. Right, so we'll keep it at level. Okay, policy riders are included even in California. So F&G is really good because it has the terminal illness, critical illness, chronic illness. Okay, you can add additional riders if you wish. We're gonna leave that alone. Okay, and then
Yeah, I think I know. Because if it's increasing, then you're just pushing up the cost of insurance.
yeah.
But it depends, if the client wants more insurance for the future, then.
Yeah. So the issue for the increasing is it increases the cost of insurance, but it's a plus because if the client dies, the death benefit is automatically increased with the cash value.
Plus, I mean, you have you put on increasing, it gives a much better return when it comes to living benefits.
Yes.
So yeah. So to add to that, if you were an increasing, if you had if you have a living benefit, you have a better return on the living benefit.
So the difference in reality, if you leave it at level per se, versus the cash accumulation, in the ones that I've done, I mean, there's been a difference only for like
minuscule.
$25,000. It's not really that much,
Yeah.
but it makes more sense to do the living benefit.
Yeah.
If the guy, like,
Yeah. Accumulation wise, levels a little bit better, but there's a lot more plus to an increasing. All right, so that's it. You click calculate, the PDF comes up, you can send it to your client, you can open it, save it. Okay, so we're gonna click it, it's gonna download again. So that was the issue, it downloaded and it opens it into a Office. Okay, I said discard changes. Before you open it up, please choose what you want to do with this file. I guess we'll save it.
Just hit this device. This device.
I think I just needed to put a name on it. 3, okay, whatever.
Where do you want to save that?
Documents.
All right. Okay, hopefully it opens the new one. 31,500. Okay, perfect. Okay, so face amount. The minimum needed, because we're funding this well,
That's right, 500.
451,000 for a 31-year-old. Max funded. Okay, has the riders right there. Okay, so let's go back down to the illustration, which is the most important part. Okay, we're gonna skip down to the 65. Okay, so total premiums from 31 to 35 years, he paid in $210,000 total. His first year, he gets 100,000. His second year, he gets another 100,000. So he gets all his money back in basically 2 years. In 5 years, he would have gotten 500,000 already. Right? All right. So if there was no what do you call it? Interest rates gain, it still will last him until age 67. At a small 4.75, it'll last him till age 72. Okay, which is the current though at 6.91. It'll last him forever. Okay.
John, quick question.
Yeah.
Can you scroll back up to the other
Sure.
page? Right there.
Yeah.
So if he started the IUL at 31,
Okay.
does this have a surrender period? This policy? Will he get dinged if he pulls out within that first 5-10 year period?
So she has a question about the surrender period. Okay, so we haven't mentioned this to you. So typically IULs, when you set it up, if you cancel a policy, there's usually a 10-year surrender period. So you have your cash value, but they dock you if you cancel it. And so this is your real cash value minus the surrender period. So you see that? So even though you have an account value of 38, if you cancel on the first year, they're only going to give you 308. Okay. So when it finally matches itself, so this looks like it has a 15-year surrender period. It's very small on the 14. It gets really small from then on. Yeah. So you're better off borrowing the money than surrendering the policy. Because when you borrow, you could borrow off the cash value. If you surrender, you cash out, you're only getting that. Yeah. Yeah, 500 a month. So that also prevents, the reason why they do that is, they want to keep the policy and they want to also prevent replacements, right? Because if you go from FNG to Global Atlantic to National to wherever, you're only transferring this cash value. You're not doing this. But if you borrow and you keep paying us, we keep your policy. So protection. Yeah, same thing with an annuity, 10-year, what do you call it?
Well, wouldn't it be smarter that way to borrow from the policy, because technically you'd be paying yourself?
Right, right. And this is something Misha talks about. When you borrow from the policy, it doesn't take away from the accumulation of the policy. It just takes away from the death benefit.
When you pay it back, do you pay interest or no?
Yeah, yeah.
How much is that, do you know?
It's probably in here. Each company is like 4, 5, 6,
And
7.
interest is to yourself or to the insurance company?
Back to the insurance.
But if you don't pay it back, doesn't it come out of the death benefit?
Yeah.
So,
But when you're doing these big things, shoot, borrow 50,000, take out of this, you're fine. So imagine even even back here at 66, right?
Yeah.
You can borrow 493,000, die at age 72, and you'll still have 826,000 death benefit. Okay.
Did you cover your mortgage?
At that point, your mortgage is paid. This is a fine, nice retirement plan.
Houses are gonna be
Refinance.
I'm mine. I have mine in the bank.
Yeah. Any questions? We're good?
Very good.
Yeah, so you can build it up. And then remember, you don't have to take incremental premiums per year if you don't need to. This is just an illustration on how much you can borrow and safely keep the policy going. So you can create an illustration where you only want to do it for 10 years. Like, let's say at 80, like, you got no legs. You don't need to you don't need to do a vacation anymore. You're out of let it grow. But yes, that's where it's useful for long-term care, whatever else. Let the family and the kids keep it. Yeah. So if this guy, 31-year-old, does it right, at age 80, he's only paid $210,000, got 1.48 out, and still has a death benefit of $436,000 from where he started.
Wow, that's good.
So it's all about finding those type of clients that are willing. If you find a client that doesn't care about death, but they still want something, so this is where this comes in. You got these crypto investors, they're losing money in their crypto, tell them, hey man, you can get into IUL.
401k investors are.
You could get some gains, get some good gains. Make sense? So it's all about finding your clients and understanding the IUL. It's even crazier when you do it for a 1-year-old, 2-year-old. It's just a matter of higher face amounts. So who can we sell? We can sell a lot of people. We can sell 60 to 70 for more of a death benefit, cheaper cost in the final expense, or you do a high accumulation on clients.
Some of the policies I see start at 18 years old now. So how do you do a 2-year-old?
Yeah, they're spines. Same thing. They'll just be on a standard rate instead of getting the preferred rate because we can't do a physical on them.
And they have a max face amount.
Yeah.
John, I have a question on that. What's the earliest that we can start to fund an account for a brand new baby? So like
14 days.
14 days, right?
Yeah.
So that hasn't changed? So I'm popping out 14 days I can get you.
Gotcha.
No problem.
So imagine you have like parents, grandparents, great-grandparents that have some money, but I mean, they can't pay a mortgage payment on their policy. Tell them, hey, do something for the young kids. Yeah. $50 a month compared to a $50,000 max child whole life with Mutual of Omaha.
That's what I have. I don't like it actually. I'm like, this would be better for 2-year-old, 4-year-old.
Right. So remember, there's 4 main needs. I did this to my brother-in-law's niece. She was 21. She has a good accounting job, but she didn't have any insurance needs. Like she lived at home, so she doesn't need a mortgage. She's 21. She doesn't need to take care of her final expense, and she didn't have any kids. So what's her insurable interest? Well, let's talk about an IUL. Start it off slow and build into it, and you're good to go. I did one for my college buddy's wife. She makes a good job, but she's 1099. He's a firefighter, fire department. He has benefits, so he has 401k. I said, oh, you don't need the IUL. She does. So I just gave him a term. I gave her an IUL. So she's going to make about $50,000 per year from it by the time she retires. She got it at 30, 32, 33, paying like $235. That was one of my first IULs. The only issue was my target premium was $400. The premium was $235 a month. I'm all like, why did I only get paid $400? I didn't know about the difference between target premium and the cash value. So I'm thinking this is a $2,400 policy, right? It's on my account. Dang. I did some free labor.
But it will be replaced.
Just can't. It can't be replaced because once you see these numbers, it's going to be set there in motion. Yeah.
Firefighters, isn't that one of the riskier?
But he has a 401k, so as an investment account, his company or the department department will match. So the IUL can't beat that.
So you said you had a term for him.
Yeah, just added an additional life insurance for him. Max funded hers.
Okay.
Yeah. Cool. That's pretty much it. That's the gist of it. It's like so. You just got to identify like who can we sell to, who's the prime client. But what this knowledge will do for you is that if you are with a client that's able to have disposable income 200, 300, 400 a month, we can plug it into this. Now, will you get the whole 400 a month premium, the target premium if you're max funding it? No, but it's still a 450, 1,000 face amount. So there's a decent premium in there. Right?
Like it. You could sell a young person by telling them get a second job, and your second part-time job would be funding your
Yeah,
retirement.
there you go. Second hustle for the retirement.
You can use that.
Or then you tell them, hey, you know what? You can get this policy. You can work with us as your part-time job. You could sell this policy to fund your policy. You get a free policy by selling this. There you go.
I know when I had a client during the pandemic, and they're actually still actively using it when I was with the NLG. It was a mom. She had 3 kids. So I think the oldest one was like 10, and the youngest one was like, I think 3 or 4. So we leveraged the 3, 4-year-old. So what we did is like, she was like, how would you like to see if you can make like $1 million policy for your 3-year-old? And so we did exactly that. She goes, yeah, but I want to do 3 policies for each one.
Nice.
So I asked her, I said, how much do you get on your tax return money? And then she was like, well, what do you mean? I said, well, what do you use the money that you get back from your taxes? She goes, well, I gotta pay this, I gotta pay that. I said, how dare you? I said, that's your kids' money. That's you pay your credit card debt.
That's good.
So
Yeah.
So we ended up basically splitting up the amount that she gets. So a portion of that, we use the tax return money to overfund
The policy.
3-year-old. And then a percentage of that, she'd put it on the side for the next year. And
For
then
the next
rest
premium.
she could go ahead and allocate it to other
Yeah.
stuff,
Yeah, it gets crazier. You can do policies where you do a one-time pay up, 7 pay, and just leave it the way it is. So it's really good. So if you find clients that had a death benefit payout, they had a life insurance payout, they don't know what to do with the money, they don't know where to stash it, you could just stash and front load an IUL for them. Let it sit and it'll grow by itself. Same thing if they want some lotto or whatnot.
And you could pull it to do whatever you want to do.
Yeah, you could do a 7-pay premium, leave it the way it is, spend the rest of the money, at least you have something to back it up.
I know for me, like that strategy worked for her because she obviously didn't make a lot of money, but she was the one cleaning all the kids. They were separated, that's why.
There you
She
go.
cleaned the kids.
So now she can use that as a future income for herself
Yeah,
or
so
the kids
basically,
later.
It's like, like realistically, your initial thought is, well, I don't make enough to fund all 3, so I can only do
Yeah.
1. So now that
I mean, you'll be surprised. There's a lot of people willing to pay $200, $300 on their phone bill, but they see this as, an expense. So it's a matter of finding the right clients and then understanding it, what it'll do. So like Sean Richier calls it like the Swiss Army knife. Take care of the house, take care of the death benefit, everything. And you can pull a lot from it. That's all we got. Cool. Thanks for showing up.
Thank you.
Can I clear